Hello everyone, and welcome back to the channel. Today, we're doing something a little different. We're jumping into our financial time machine and setting the dial for January 2026. What will the US stock market look like as we kick off that year? This isn't just about predicting numbers. It's about understanding the deep structural forces that will shape our investments. Forget the usual January season. By 2026, we'll be in a decisive phase of a long-term economic cycle influenced by technology, Fed policy, and global capital flows. So, let's get into our comprehensive scenario-based forecasts for January 2026. First, let's paint the macroeconomic picture. As we enter 2026, the U.S. economy is expected to be in a state of controlled, resilient expansion. Think moderate growth, not an overheating engine or a sputtering stall. Why? Inflation will likely have stabilized from the turbulent post-pandemic years. Interest rates will be on a path to normalization, and corporate balance sheets are projected to remain strong. The labor market should also be healthy, even if the pace of job growth has slowed. But here is the catch. The market in late 2025 will have already priced in a lot of this good news. This creates a fragile balance. Any positive economic data could add fuel to the fire, but any negative surprise could trigger a swift and punishing January is a month that often amplifies market sentiment. So if 2025 ends on a high note, we could see that momentum carry over as institutions reallocate their funds for the new year. Now, let's talk about the biggest player in the room, the Federal Reserve. Fed policy will be one of the most powerful catalysts for the market in January 2026. By then, the Fed will likely be in one of three positions. First, they could be holding interest rates at a neutral level, signaling confidence that inflation is truly under control. Second, they might be starting to gradually cut rates if economic growth shows signs of slowing down without reigniting inflation. Or third, they could be holding rates higher for longer if inflation proves more stubborn than expected. The first two scenarios are very positive for stocks, especially growth in tech stocks. Why? Because lower interest rates increase the present value of a company's future earnings, which disproportionately benefits innovative, long-duration assets. This means that in January 2026, the market will be hanging on every word from the Federal Reserve. We'll see extreme sensitivity to the language in their FOMC statements, the latest inflation data, and labor market reports. Even a subtle shift in tone could cause an outsized market reaction, especially with valuations already sitting at elevated levels. Ultimately, though, stock prices are built on one thing: earnings. Corporate earnings are the bedrock. Heading into 2026, analyst expectations are quite optimistic. They projecting solid double-digit earnings growth across the S&P 500. Corporate profit margins are also expected to remain strong, thanks to the massive efficiency gains from automation and AI, as well as continued pricing power. Companies will have been spending heavily on technology, data infrastructure, and other productivity-boosting investments. January 2026 will be a critical month because it is when we get the first wave of earnings guidance for the year ahead. The market will be far less forgiving of companies that miss their targets. But for those that deliver strong, forward-looking guidance, the rewards could be huge, with aggressive buying pushing their stock prices higher. The giants of the tech world, the large-cap names that dominate the major indexes, will be especially influential. Their narratives around AI monetization, cloud growth, and cost management will set the tone for the entire market. So, where will the money flow? Let's break down sector leadership. Unsurprisingly, technology and artificial intelligence will continue to be the dominant structural theme. But by January 2026, The game will have changed. Investors will be less interested in the speculative hype around AI and more focused on tangible results. Who is actually generating revenue from AI? Who is turning that revenue into profit? And which companies are seeing widespread enterprise adoption of their AI tools? This shift favors the established tech leaders, the big players who have the scale and resources to deliver, rather than the early-stage speculative startups. Next up, financials. Banks and other financial institutions could be in a sweet spot. They stand to benefit from stable or even declining interest rates, which can improve their lending conditions and reduce credit stress. However, their performance will heavily depend on the behavior of the yield curve and any new regulatory policies that might come into play. Then we have industrials and infrastructure. The trends of reshoring supply chains, investing in the energy transition, and upgrading national infrastructure are long-term drivers. If the economic data remains firm, these sectors should continue to see strong support in capital inflows. And finally, don't forget about small and mid. These smaller companies have historically been more sensitive to interest rates. If the Fed does begin to ease its policy and cut rates, January 2026 could mark the beginning of a major rotation into small-cap stocks. They tend to outperform in environments with lower borrowing costs and improving economic growth expectations. So this is a key area to watch. Let's shift gears and talk about market psychology. The mindset of investors entering January 2026 will be defined more by high expectations than by fear or uncertainty. This is a crucial point. Markets are often most fragile not when everyone is scared, but when confidence is widespread and complacency sets in. This means that any negative macro surprise, even a minor one, could trigger fast algorithm-driven. We could see volatility spike dramatically without any real breakdown in the market's fundamentals. Corrections of 5 to 10% could happen in the blink of an eye, only to reverse just as quickly. January is traditionally a month where institutions reset their portfolios, rebalancing their holdings and adjusting their risk exposure for the year. This activity alone can create sharp but temporary price swings that can catch unprepared investors off guard. It's also useful to look at history. While the old January effect isn't as reliable as it once was, the beginning of the year still matters. January often sets the tone for the months that follow, largely due to new capital PENSION, fund reallocations, and tax-related If January 2026 starts off strong, it will reinforce the bullish narrative and build confidence. Conversely, a weak start could amplify caution and lead to a more volatile first quarter. So, let's put it all together into a few possible scenarios for January 2026. First, the bullish scenario. In this world, we get strong earnings guidance from major companies. The Fed signals flexibility or even hints at rate cuts. Technology and growth stocks take the lead, and the major indices break out to new all-time highs. It's a continuation of the optimistic trend. Next, our base case, which is the most likely scenario. Here, the market is choppy but has a general upward bias. We won't see a straight shot up, but rather a grind higher. Beneath the surface, there will be intense sector rotation as money moves between different industries. Will experience increased volatility, but without any structural damage to the market. It's a period of consolidation, followed by selective breakouts in the strongest sectors and companies. Finally, the bearish scenario. This would likely be triggered by a surprise jump in inflation or an unexpected hawkish move from the Fed. We could also see widespread earnings disappointments, signaling a crack in the corporate profit story. In this case, we could see a rapid correction of 8 to 15%, with investors flocking to defensive sectors like utilities and consumer staples for safety. So, what does this all mean for you as an investor? January 2026 is not shaping up to be a quiet month. It will demand discipline, careful risk management, and the flexibility to adapt. For long-term investors, the strategy remains the same: focus on high-quality companies with durable earnings and strong balance sheets. These are the businesses that can weather any storm. For short-term traders, prepare for those spikes in volatility and sentiment-driven moves. Be ready to act quickly but thoughtfully. To wrap it all up, the U.S. stock market in January 2026 is poised to operate in an environment of structural optimism, but that optimism will be tempered by high valuations and sensitivity to news. The underlying trend remains constructive, supported by solid earnings growth, ongoing technological transformation, and the potential for supportive monetary policy from the Fed. However, because expectations are so high, the market will have very little tolerance for negative surprises. January 2026 won't just be a reflection of where the market has been. It will be a powerful signal of where capital, confidence, and conviction are headed next. Thanks so much for watching. If you found this forward-looking analysis helpful, be sure to hit that like button and subscribe for more deep dives into the markets. I'll see you in the next video.